Everyone thinks life insurance is modern. It's not, it's just been repackaged. The real story starts centuries ago, not in boardrooms, but in graveyards. Working families faced a genuine terror, dying without enough money for a proper burial. In 17th and 18th century Europe and America, a funeral could consume months of wages. So ordinary people banded together and formed burial societies, mutual aid groups, where members paid small, regular fees into a shared pool. When someone died, the society paid for the grave, the shroud, the service. It was insurance, but it wasn't called that yet. By the 1700s, these burial societies had evolved into something more sophisticated. Merchants and traders realized that death could derail entire family businesses. A ship captain dying at sea meant his widow lost income, his crew lost employment, his creditors lost repayment. So the first formal life insurance companies emerged in England, then America. They collected premiums, calculated risk based on age and occupation, and paid beneficiaries upon death. The math was crude, but the principle was revolutionary. You could quantify the financial value of a human life. The Industrial Revolution turbocharged this. Factories meant thousands of workers with dependents, all vulnerable to sudden death. Insurance companies saw a massive market. They competed fiercely, refined actuarial tables, and began offering different products: term life, whole life, endowment policies. Each structure shifted the risk and benefit in different ways. What had been a simple mutual aid pool became a complex financial instrument. Here's what shifted. Life insurance stopped being purely about protecting against poverty. It became an investment vehicle. Whole life policies accumulated cash value over time, money that policyholders could borrow against or surrender for cash. Insurance companies invested premium dollars into bonds and real estate. Suddenly, life insurance was tangled with wealth building, tax advantages, and estate planning. It was no longer just about burial. It was about financial legacy. By the 20th century, life insurance had become one of the largest financial institutions in America. Insurance companies held trillions in assets. They shaped urban development, influenced corporate structure, and offered products so varied that comparing them required actuarial training. A policy wasn't just a promise to pay upon death anymore. It was a contract with dozens of moving parts: premiums, riders, surrender charges, death benefits, cash values, and conditions. The transformation reveals something deeper about how financial products work. They start solving a real, urgent problem, in this case, the terror of leaving your family destitute. But as they mature, they become tools for the wealthy to preserve and grow assets. The burial society that helped a blacksmith's widow pay for a funeral evolved into a sophisticated instrument for tax deferral and estate transfer. The need was real. The solution just kept getting more complicated. Today, life insurance exists in dozens of forms: universal life, variable life, indexed universal life, each with different cost structures, flexibility, and risk profiles. Most people understand it as simple: you pay, your family gets paid when you die, but the actual mechanics are layered. Understanding that history, how a mutual aid solution became a financial product, helps explain why modern policies are so dense with conditions and fine print. Life insurance didn't invent itself. It emerged from fear and mutual need, then was refined, marketed, and engineered by institutions seeking profit and scale. That's not a criticism, it's how many consumer products evolve. But it matters. Knowing where something came from helps you see what it's actually designed to do now and what it costs you to maintain it. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you don't miss the next time we decode how a consumer product became something far more complex than its original purpose. This video is for educational and informational purposes only and is not financial advice. Always do your own research.